Hello, welcome. This is Seewing Yi from the Yi Real Estate Network. All right, so let me cut to the chase. All right, I'm going to ask you guys to share your thoughts. Okay, and by the end of this short video, I would like you to make a comment below at the bottom of my video and answer my questions. Okay. And what kind of question? Well, you're going to find out momentarily. So here it is. If you are a experienced real estate investor, wherever you located, does not matter, anywhere in the country, anywhere overseas, because you have the ability to buy these kind of properties remotely, passively, as long as you use the right reputable turnkey provider in that marketplace that will do most of the work for you, property management, help you do everything remotely out of state. All right, so having said that, if you are an experienced investor, if you have owned at least one rental property in the past, anywhere in the United States, I assume, well, I hate to assume, you know the 1% rule. The 1% rule is the rent to value ratio. Okay, it's the rent to value ratio. This means if you buy an investment property for $100,000, multiply by 1%, which is the rent to value ratio, and the answer is 1,000. That 1,000 is the monthly rent that you're collecting from your tenant. So that's the 1% rule. So if you buy an investment property for $100,000 anywhere in the United States, I'm using a lot of hypotheticals and assumptions. Multiply by 1%. That's a magical number that investors have been using for many, many years. And I've been doing it for 30 years. And I've been running my real estate investment club for almost 20 years. And we have thousands of members within our real estate community that I guide and consult and recommend to our investors buy in these affordable markets for cash flow, 25% down payment. Now, so this 1% rule is the magical rule. If you're able to meet this rule and take action on it, if you can scale your portfolio by more than one properties, that is, you're going to achieve some very good generational wealth, long-term buy and hold single-family homes. 1% rule. So here's the problem, right? This rule has been working for a lot of years up until these past few years, when skyrocketing appreciation and all that has made houses very, very expensive, even for investors, whereas the number does not make sense anymore. So if you are a savvy investor, the 1% rule, $100,000 multiplied by the 1% is right now, as we speak, right now is we're moving to the latter almost fourth quarter 2022. It's very, very hard to get unless you're buying investment property in the Midwest, right? Historically speaking, in the Midwest, right? You know what I mean by Midwest? Like Ohio, Illinois, Tennessee, or Indiana, those Midwest areas where the prices are very, very low, right? And the rent is high because the appreciation is not as high, right? But those properties are older, much older, right? So still currently that market, I would say the Midwest market still works very well for a lot of investors over the years, including now. But lately, the last couple of years, it has lost its luster, right? The cash flow is very good. It can still meet the 1% rule in many of those markets. I can't go over the details of it because it will take too long for me to explain on this video. But a lot of the investors, they have deviated from the Midwest, the blue collar market, right? The Rust Belt, if you will. So, and many people over the last few years, many investors have ventured into the Sun Belt investment methodology, if you will, right? They buy investment property in a very fast appreciation markets, and they have done very well, right? Especially in the south and southeast, right? So moving forward, again, a lot of people, investors, especially last few years during the pandemic, they have purchased in the south, in the Sunbelt areas, south and southeast and southwest, and they achieve a massive amount of appreciation. 40, 50, 60, 80, 100% appreciation in just about 2 or 3 years in many cases, right? I know each market is different. So I know some of you are thinking, oh, I don't want Midwest market anymore. I don't want to invest in C-class properties with with marginal tenants, even though the cash flow is high, but the property is older, even though it has been rehabbed properly by the rehabbers in that market. Still, right? You want more than cash flow. You don't want any kind of headache. I get it. So let me cut to the chase. If you want Sunbelt area markets where there's high growth, still affordable markets where you can still cash flow and achieve potential long-term appreciation. But here's the problem: you're not getting the 1%, right? You're not getting the 1% rule because the properties in the Sunbelt areas, especially in the south and southeast, has risen so significantly in the last few years, and the rent has not caught up, although the skyrocketing of rents is catching up. Really, if you think about it. I'll share with you that video some other time. In fact, you click on my YouTube channel, you'll see it. How cash flow skyrocketing rents has really turned the page for real estate investment world. Anyway, with that said, so if you want to buy in the trophy markets, it's very hard to get that 1% rule. It's very hard to cash flow with 25% down payment and all that. But well, I'm going to show you something that nobody ever talked about. The mass media, the YouTube people, whoever you've been coming across lately, for those savvy investors, you're seeing this for the first time. For the newbies out there who have never invested, this presentation may seem a little bit overwhelming to you. Maybe not. I'm not sure. So, all right. So I'm not going to divulge a lot of information, but I'm going to have you answer. If you want to, that is. You can volunteer to make a comment at the bottom of my video after you listen to this presentation. Then answer it, and I will try to get back with you. Okay. Also, it wouldn't help if you like my video, you click your thumbs up my video, and subscribe to my channel, and also most importantly, to put your email into our website database, so you can become a free member of our organization, and you can receive through the email you submit to our newsletter database. You can receive weekly investment free information. Okay, so this property, which is, you tell me if you can find a property somewhere in the US that fits this numeric module, if you will, let me know, because I will tend to think this place, I'm not going to give away where it is, but this place is available for investors to purchase. And let me tell you the numbers. Let me cut to the chase, okay? I don't want to spend too much time. This is a brand new construction, 3-bedroom, 2-bath, 1,350 square foot. It is selling below market value at 20% below appraised value, because we have a builder that willing to build for our small investor community, which you could be part of it, right? So anyway, it is selling for $249,000. It is appraised at around $300,000, maybe even more. How we come to this conclusion? There's another builder in the area of building similar square footage, similar type of model and all that, and they're charging at least $300,000. Okay, so here we go. So you buy the 249, you will meet the 1% rule. A trophy market where there's a bidding war by renters and the quality of the tenant is such that it's A-class tenant, A-class location, very fast growing. The supply of inventory in this sub market is way below the demand. The demand is very high, and there's a population growth, job growth, and there's a migration of people from all over the country coming into this area. People from the Northeast, people from California, people from the Midwest, Chicago area, they're converging into this state and into this sub market, right? I will eventually divulge the exact location, but for now, I would like to get your input. So the key is, see right here, rent to value ratio, 0.9%, pretty much 1%. So 1% multiplied by the purchase price, 249K right here, and the rent, gross rent is 2,200, at least right now, right? Because the skyrocketing of rents are slowly catching up with the housing appreciation in many markets, including this one. So you're getting 2,200. Believe it or not, a renter is potentially paying you at least 2,200, probably more the next 6 months or 12 months or longer, because there's a lack of housing to rent, there's a lack of housing to buy, and many of the people making 60, 70, 80 grand, 80,000 or higher, they are unable to buy, they can't buy, they won't buy, they rather rent, and they'll, those renters are more than willing to help, to pay $2,200 to rent this place 1 year annual lease. So let's do the number, right? The numbers are staggering, I would say. Hopefully you agree. The rent to value ratio is almost 1%. The capitalization rate is 7.8%. Again, I'm not going to go through the details. It'll take too long. Cash on cash return, 9%, whatever, so forth and so on. So you put a down payment, $25,000, down payment $62,250, and all that. And then the interest rate you're paying as an investor, at least 6%, right? At least 6%, right? Is that amazing? You're paying at least 6%, maybe 6.2%, give and take, right? Because of the volatility of the mortgage interest rate on a 30-year fixed rate mortgage. And at the end of the day, your gross rent of $2,200 minus your debt service, right? Your debt payment, mortgages, taxes, insurance, property management fee at 8%. At the end of the day, you still have left over a whopping almost $500 monthly net cash flow. Okay, I'm not going to go any further. Okay, I'm not going to go any further because now it's time for you to guess. So 1% rent to value ratio, which is unheard of as far as I'm concerned. You're not going to be able to buy this type of homes, beautiful new construction at 1,350 square footage, is one of the fastest growing areas in the country, bar none. It will continue to grow exponentially for years to come. And given this very challenging market, right, a lot of negativity going on, as you know, right, it's all over the news, negative headlines, whatever. If you target a right sub-market, if you surround yourself with a great team of people that can help you buy these kind of properties, I mean, it's amazing, right? This is an off market. You know, the regular people out there, they would not have access to this type of opportunities only if you become a member of a real estate community, which is free. You know, it's not like we're charging you. All right, so that's pretty much it. So you see the number, right? Amazing cash flow, amazing appreciation potential, but it's a long-term buy and hold, don't get me wrong. Again, make your comment below on my video and try to answer the question, right? $244,000 property, 1,356 square foot in one of the best location in the country. multiple tenants, bidding war by tenants, knocking on your door to rent your property, and the returns are the yield, the cap rate, the rental value ratio, in the whole 9 yards, all the number crunching that can go on forever. So that's all I have to say. Just make a comment. I will do my best to answer your comment. If you want to go further, you know what to do, right? If you see value on this presentation, please click the like button and subscribe to my channel, and also put your email into our database on my website, and you will become a part of our real estate investment community. Free membership. All right, the trifecta. Like, hopefully you like. Click the like button if you like my video presentation. Click subscribe to my channel, and join up to our newsletter. The trifecta of investing. Thank you so much, and for watching. This is Seewing Yi from the Yi Real Estate Network. Have a nice day. Bye bye.